Before we start this video, do like and subscribe to our channel and not miss on any updates.
So friends, today we are going to revise the chapter called Security Analysis. Now this is a chapter in which there is a lot of theory, a good amount of theory, but not many questions have actually been asked in the exam. Very basic questions have been asked and there is good amount of practical issues involved. I won't say good amount, actually there are only two kinds of problems. One is about autocorrelation, other one is a run test. There are hardly 5 problems. So students typically consider this chapter as a very light chapter, but believe me, this chapter also has its own specifics or nuances or intricacies. So I would strongly suggest that you don't ignore this chapter, because if they give a question, you will straight away get an 8 mark or kind of a question, which is a run test or an autocorrelation test. And also please note, the autocorrelation test was asked for the first time sometime in 2021 or 22. Till then they had never even asked it. Okay, so please don't ignore this, and in fact that autocorrelation is not even there in the syllabus as a part of questions that were asked ever in the past. Okay, so the question also was not there, they asked directly in the exam. I don't expect that kind of a scenario to happen again, but nevertheless, it does pay to be prepared. Right, now let us look at theory. From a theory perspective, security analysis chapter, there are 2 questions. Questions have been asked 2 times in the exam. Okay, and both the times it is the same question. There is only one question that has been asked. I will actually take you through that, and of course all the rest of the theory as well. Security analysis, there are about 19 questions, and in fact in the new syllabus they have also added a new topic about equity research. What is equity research? I don't think that's a very big question per se, because it's a very small topic. I don't know why it has even been added when they have not given enough stuff in it. Okay, it's just hardly 5 lines and some 10 tools used by research analysts. So I don't know what is the intention, but anyway, I will take you through whatever it is. Now there are 19 questions plus of course that research analyst equity research, so basically 20 questions. And out of this, 1 question has been asked in past exam, it has been asked twice. So basically research, security analysis, first question is, what is fundamental analysis? Fundamental analysis is based on assumption that share prices depend on future dividends. So basically there are 2 types of analysis, fundamental and technical. Fundamental focuses on numbers, technical focuses on waves and patterns and charts and trends, and basically it uses graphs. Whereas fundamental analysis is basically where you try and figure out, try and go through, understand the company, understand the financials, project the financials, take the dividend streams or take the cash flow streams and arrive at the value of the share. Basically that is fundamental analysis. And what do we say? The present value of future events can be calculated by discounting cash flows. The intrinsic value of share according to fundamental analysis depicts the true value of a share, and share is priced below the intrinsic value, it must be bought. So if as per fundamental analysis, if when you arrive at a price, let's say you arrive at a price of 100. Okay, this is called as the intrinsic value, and let's say in the market the price is 80. So this is below the intrinsic value, so this you should buy. So let's say the price is 120, it is above the intrinsic value, so you should sell. So basically that is what you do when based on fundamental analysis. And the price the shareholders are prepared to pay for a share is the present value of future dividends, and hence they expect to receive of the dividends they expect to receive on share, and this is the price at which they expect to sell in future. So basically fundamental analysis is analysis where it is concerned about valuing the share based on future stream of cash flows, which are basically dividends for shareholders. Okay, and it is a present value of that. The intrinsic value depicts the true value, and if it is low, if the market price is low, buy; if the market price is high, sell. Okay, then what are the components of fundamental analysis? So there are 3 basic components of fundamental analysis. One is economic analysis, industry analysis, and company analysis. Now they are given in great depth, each one of them. So I would rather explain each one of them in depth, and you summarize. If at all this question gets asked in the exam, you provide a summary of each of these things, which is in the economic, industry and company. So think of it this way: first country, then the industry, and then the company. Okay, so let us look at what is economic analysis and what are the techniques used in it. Basically, what is economic analysis? How do you analyze the economy? So you basically look at growth rates of national income. What is the GDP? How is it growing? What is, is this particular country growing? Is India a growing country, or is it a country which will see better growth rate in future, so on and so forth. Out of that, what are the industries that are likely to grow? Some industries may perform, some industries may not perform well. Then you may have issues like pay commission. So in case of a country like India, whenever pay commission revision happens, suddenly there is lot of economic activity in FMCG stock, not FMCG, I'm sorry, consumer durable stocks or auto stocks, so on. Inflation. If inflation is very high, then people typically do not make big buying decisions. Then monsoons. If the monsoons are very good, then obviously the rural economy will do well, and then that will help certain specific sectors, industry stocks like agri or automotive or two-wheelers or tractors or things like that. So this is what you do in economic analysis. This is basically you try to arrive at these kind of and make an understanding or get an understanding of these kind of aspects and figure out how the economy is going to do in the near term. And then what are the techniques that you use? There are three kinds of techniques: anticipatory surveys, barometer or indicator approach, and economic model building approach. So basically these are three approaches. They have given it certain depth in the material or the syllabus what is there. I don't think that depth is required. You basically go and ask for very simple. You write 2 to 3 lines about each of them. It is more than sufficient. What you do in anticipatory surveys, you basically go and ask people what do they think, how do they think this is going to happen, the economy is going to perform in the future, what are their expectations from it, so on and so forth. You do enough people ka survey. Second, barometer indicator approach. So there are certain indicators of economy doing well, or how an economy will perform. Interest rates, inflation, credit, banking system, NPAs, stock market. So these are all indicators. Some of them are leading indicators, some of them are lagging indicators of the economy. So you actually try and understand these indicators, which will tell you the direction in which economy is going, which phase of the cycle. So a lot of you would have seen this, no? There is a cycle like this. This is boom, this is depression, in between there is recession, moderate growth, like that. So there are a bunch of movements or a cyclical nature of the economy. You try and understand where in the cycle are you. Then third is economic model building approach. So you try and build a model, you try and understand exactly how the economy is functioning, what are the various industries, what are the levers in this economy, and what moves the economy and overall GDP growth rate, how is it arrived at? Probably say split the total country's growth into, or country's national income into agriculture, industry, services. From each of them, how much will you grow, what is the growth prospect, so on and so forth. Like that, you probably try and build an economic model. So if you write this about this, I think it is more than sufficient. Then what is industry analysis and what are the techniques used in it? So industry analysis is trying to estimate, just like the way we did for an economy of a country, we are trying to figure out what is likely to happen to an industry. What are the prospects? Is it positive? Is it negative? Is it going to grow? Are there any headwinds? Headwinds means anything that works against it. Positive, negatives, right? So industry analysis, the basic profitability of any company depends on the economic prospects of the industry to which it belongs. The factors affecting industry analysis are as follows. First one is product life cycle. So what happens in product life cycle is, in early stages there is high growth and probably high probability, in medium probability in maturity stage, and sharp decline in last stage of growth. So once the industry matures and it becomes sort of a commodity, so then that particular industry, everybody will have low margin. So it is very important to understand in which life cycle stage is the particular industry currently. So if you think of sectors like, let us say, telecom, they are mature or probably last stage. If you think of sectors like e-commerce, probably they are in middle stage. If you think of sectors like power, they are also again probably in mature stage. So like that, you have to understand what stage your specific industry is in. Then demand supply gap. So if there is excess supply, the prices will come down. If there is excess demand more than supply, then your price you will always have price power. You can command price. Barriers to entry. If there is high profitability in industry, everybody will come. But if there are barriers, like they can be regulatory barriers, technological barriers, IP, intellectual property barriers, or the first mover advantage, things like that. If there are any large barriers, then that particular industry, may survive. However, if there are no barriers, anyone can walk in, anyone can walk out, then obviously it becomes very difficult for anyone to survive in that industry. Government attitude, if there is a lot of regulation, very tough, right? Competition, in competition, what is the thing? How is it extremely competitive? What kind of competition is it? Is it too many players, fragmented market, or is it oligopoly? Is it monopoly? You have to understand. And why will that be important? Because it will define the market leadership. It will define whether foreign players can come in and attack, and whether there is any product differentiation between so many competitors. If there is no differentiation, then it's a commodity. If it's a commodity, then it is in the large stage, basically means margins are low, right? Then cost conditions and profitability. Profitability depends on cost control measures, production capacity and level of CapEx required for productive efficiency. So, the profitability not only depends on the price, how much you can charge, basically how much margins you can earn, but also depends on the cost aspects also, which is basically how much can you control cost, what is the capacity, how can you effectively utilize the capacity. Then technology and research. Industries which update themselves have a competitive advantage over others in terms of quality and price. So, this is what I was telling you. So, in industries with high technology, right? So, you have always have to be at the forefront of technology, and the people who are at the forefront of technology will always earn higher margins. What are the techniques used in industry analysis? Regression analysis, and in regression and input and output analysis. Regression analysis is very simple. All of us know regression, simple linear regression. I explained to you in one of the earlier chapters. Investor diagnose the factors determining the demand for output of the industry through product demand analysis. Factors to be considered GNP, disposable income, per capita income and price elasticity of demand. For identifying factors affecting demand, statistical techniques like regression analysis and correlation are used. So, what are we talking here? Basically, if in case of when you're trying to use regression analysis, you are trying to arrive at the growth rates for the industry by linking it to GDP, by linking it to what are the thing, per capita consumption, disposable income. So, you use a multiple sets of factors and arrive at some sort of an equation which will give you how the industry will grow. That is basically what is a regression analysis. Then you have something called as input-output analysis. It basically talks about flow of goods through and services through the economy, and intermediate steps in production process such as goods from raw material stage to final consumption. So, basically, what is the input, what is the output? Is it at the input raw material stage, or is it the input at intermediate stage, or the output is in the intermediate stage? What is it and how is it actually going to, for this particular, where does this industry fit in? Does it have lot of raw materials, or is it dependent on directly lot of intermediate produce, or it produces goods which are intermediate produce for some other industry? Those aspects help you analyze how this particular industry is going to behave. Okay. Next, what are company specific factors considered in fundamental analysis and what are the techniques used? First one is book value of share. All of us know net worth by number of shares is book value. Book value is based on historical. Book value represents intrinsic worth of the company. Size and ranking. Numbers like net capital employed, net profits, ROI, sales can be compared with other companies, and you can arrive at a relative size compared to your peers and figure out whether you are in a leadership position or not in a leadership position. Then sources and usage of funds, what is the debt structure, debt equity structure, how is the company getting its cash flows, how is it deploying, how much is it for long term investments, how much is for short term investments. You do analysis like that to figure out what the company is doing with the money. Then growth record, you look at PE ratio, growth rate of EPS, percentage growth in capacity levels of a company. You look at all these kind of growth rates, and future plans of the company can be known through director's report, chairman's statement, future capital commitments and technology advancement. So, basically you are trying to find out what is the potential growth prospect of this company. You are trying to use some historical data, some forward looking data and figure out how this particular company is going to perform. Then competitive advantage. A company long term success is driven largely by ability to maintain competitive advantage. Competitive advantage creates a shield around a business that allows for competitors at a distance. Basically a moat. What is the moat for your particular business? What is the advantage that you have which others, new entrants will not get, or new people who are joining or new people who are trying to start may not get, or other competitors of yours may not get? How will you get this? Probably you will have regulatory advantage, or you will have the quality of the people, or the technology that you have built, or just sheer size. So, now it is very difficult for anyone to compete with Amazon or Reliance or Facebook or Google, right? They have become too huge. So, that itself is a moat. Or people who are at the forefront of technology. So, it is very difficult to compete with people like that, ChatGPT. Very difficult to compete. They have gone ahead of everybody else. Right. Then quality of management. Quality of management must be seen with respect to, with reference to experience, skills, integrity, investors' confidence in the management vis-a-vis relationship with investors, dividend policy and financial performance. So, you have to understand how the quality of the management is, because that is a very, very clear identifier of the possible growth potential of the company. Then corporate governance. Effectiveness of corporate governance depends upon compliance with SEBI, quality of disclosures, quality of independent directors. This is a very, very key aspect in today's day and age when there are a lot of corporate frauds or people suffering of money. So, if you know that the quality of management and the governance are very good, then people typically take bets. So, examples are companies like HDFC or ICICI or Asian Paints have very, very high quality management. Okay. Then pattern of existing shareholding. So, existing shareholdings would allow the company also to figure out, to allow an analyst to also figure out who are the owners of the company? What is driving? If it is very largely FIS, then you probably will have a professional management. If there is some family business involved, how much do they hold? Do they hold too much stake or do they hold too little stake? So you have to figure out things like that. Then location in labor, location of the company's facilities, then labor management relations, availability of raw materials, skilled labor, nearness to markets, state of labor management relations. So this is largely for manufacturing companies where, location near ports, location near major consumption markets, location near major input raw material market. So it depends on kind of company or kind of industry. So how do they have any locational advantage and how are their labor relations? Then marketability of shares. So they should trade actively, the shares should trade actively, just listing is not sufficient. Speculative, how much is speculative interest in a particular script and where it is traded, volume of trading. So you also, even though it is fundamental analysis, you try and analyze what is happening to the currently the share volume, or who are the people who are trading shares. Is there a lot of speculative activities? Is it part of futures and options segment? If it is part of F&O, what are the volumes? Are F&O volumes indicating some change in direction or something, some other news which you are not aware of? So you have to do all that analysis as well. And what are the techniques that you use here? You use correlation and regression. You try and find out correlation or regression between various economic factors, industry factors and the prospects of the company. Let's say company sales, correlation with overall industry revenue. Company sales, correlation with GDP or national income. So things like that. The main advantage of such analysis is determination of forecasted values along with the ability to test the reliability of estimates. Trend analysis, basically you figure out a trend, find out a trend on how it is growing and figure which way things will go. Decision tree analysis, a range of values of the variables with probabilities of occurrence of each is taken. The limitations are reduced through decision tree analysis and use of simulation technique. Decision is taken subsequently with probabilities attached to each sequence. So this is one technique which I explained to you, decision tree analysis, in one of the earlier chapters. Advanced capital budgeting decision chapters. We have understood this. So this analysis can also be used to figure out how this company will actually move, how will its business grow, or how will it function as an organization. Now let us look at the next question. What is technical analysis and what are its assumptions? So technical analysis, basically, as I explained to you, is all about charts, trends, patterns. So it visualizes the actions of market participants in form of stock charts. Patterns are found with charts and these patterns help a trader identify opportunities. It is primarily used for short term, and a technical analyst attempts to answer two basic questions. Is the pattern identifiable? If yes, when will the pattern reverse? Okay, this is a super important question. Same question has been twice. Same question has been asked twice in exams earlier. So this is the only question that has been so far asked from this chapter. So I would strongly suggest that you study this particular question. Then assumptions in, what are the assumptions in technical analysis? First of all, market discounts everything. All information, public, private, is available in the is reflected in the price of the market, price in the market. Rational, irrational aspects. There may be a lot of rational and irrational things which determine the price or direction. We don't know. You just have to follow the market. Price moves in trends. So there is always trends. There is bull trend, bear trend, upward trend, downward trend, so on and so forth. Once a trend is established, the price moves as per the trend, and history repeats itself. So price tends to repeat itself. The market participant consistently react to the price movements remarkably similar way every time price moves in a certain direction. So these are the fundamental assumptions in which a technical analysis works. Then come to question number 7. What is Dow Jones theory? Dow Jones theory was introduced to the world by Charles Dow, who also founded Dow Jones Financial Service, Wall Street Journal. This theory is built on two indices, DJIA, the Dow Jones Industrial Average, and Dow Jones Transportation Average. Now these may or may not be relevant today, given that industry or transportation do not form a major part of the global index. Technology stocks like Amazon, Microsoft, Meta, Google, right, these are the ones that actually capture that have a larger market capitalization, Apple and so on and so forth, right. But however, it pays to understand the particular concept. There are these two indices, Dow Jones Industrial Average and Dow Jones Transportation Average. It is, Industrial Average is a stock market index that tracks 30 public companies, and Transportation Average tracks 20 transportation stocks traded in the US. As per this theory, market is in an upward trend if one of the indices advances above an important high and is accompanied or followed by a similar advance in the other. So basically, if they move together, if one of them moves and the other one follows suit or something, then market is in a trend. So if one of them moves up, other also follows, then it is in a bull trend. If one of them falls and other is also falling, the market is in a bearish trend. So this basically is the Dow Jones theory. What are trends as per Dow Jones theory? So as per Dow Jones theory, at any given time, the market has 3 trends. They are primary trend, secondary trend, and daily fluctuations. So primary trend is the main trend. So if you look at this diagram now, you will be able to understand. This particular thing, this whole thing, big box is called primary trend. Then this primary trend lasts for 1 year to 36 months, commonly known as bull or bear if it is upward, downward. And volumes must confirm the trend. Low volume signals are a weakness in the trend. So, if volumes are also good and the direction is up, then it is bull trend. Volumes are good and the direction is downward, then it is a bearish trend. What is secondary trend? Secondary trend is basically this, where it probably moves up and down. It is shorter in duration. The primary movement is in opposite direction. So, if the primary movement is up, this particular thing is in down. Primary bull trend is upwards, the shorter trend is actually slightly down. It lasts from 2 weeks to a month or more. Then you have something called as daily fluctuations, which are everyday fluctuations. These are narrow movements from day to day. These fluctuations must be carefully studied as they go to make up the longer movement. So, daily fluctuations only become the your secondary trend, right? What this particular theory proposes is, Charles Doe proposed the primary trend would have 3 moves, namely as follows: bull phase, bear phase. Had 3 phases. In bull phase, you have knowledge phase, earnings phase and excess phase. And in bear phase, you have distribution phase, public participation phase and panic phase. So, if you understand this, if you understand this second diagram, what is here, you will understand this theory very well. What they say is, in bull phase, people are accumulating knowledge, okay. So, far-sighted investors such as FIs, domestic investors, institutional investors, mutual investors invest in this phase. They are basically in this phase. Then, they invest before the earnings grow. So, earnings phase, then earnings actually happen. This is the second phase and public starts making investment. So, before the smart people invest before the stock goes up. As the stock is going up, you have the second set of people who invest. Then excess phase, speculation is high in the market, knowledge investors exit. So, what happens? Everything is in a hype, mania, everybody thinks it goes up, I want to do something. So, the earnings are great, phenomenal, this, and then the price reaches a very peak. At that time, the smart people exit and all the retail investors get stuck. This is the bull phase. Then what happens in bear phase? You have distribution, public participation and panic. Distribution is when these smart investors exit. Then public participation, this is when normal public sells off. Okay, then panic. This is basically the phase where people who are dumb, people who don't know anything about the stock, who don't know anything what is happening in the market, they exit. They exit without having clarity. They think that this company is going to die, let me exit. So, they exit the market. So, this is the panic phase. So, this is the first part is bull, this part is bear. This is what Dow Jones theory basically states, right. So, you have to understand how this particular theory functions, and there they have said, if you go back to the previous question, market is an upward trend if one of the indices advances above a previous high and is accompanied by similar advance in other index. So, if DJI climbs to an intermediate high, the DJTA expected to follow suit within a reasonable period. Then they both are in bull phase. If the ulta happens, then they both are in the bear phase. Let's move to the next question. Explain the Elliott theory of technical analysis. This is also a very interesting one. So, there is a gentleman called Ralph Elliott who formulated this theory in 1934. The theory was based on analysis of 75 years of price movements. He found that the markets exhibited certain repeated patterns or waves. As per this theory, wave is a movement of the market price from one change in direction to next change in the same direction. So, there are 2 kinds of waves, impulsive patterns and corrective patterns. Impulsive are basic waves, corrective patterns are reaction waves. If you look at this is the impulsive phase. This is the corrective phase. So, this also looks like bull bear only, that is what it is. Impulsive phase, these waves shall move in the direction of the basic movement. The movement can indicate bull phase or bear phase. These waves are against the basic movement, the direction of the basic movement. Correction involves correcting the earlier rise in case of bull market and up moves in case of a bear market. So, you see here 1 to 5, this entire part is upward trend. A to C, this entire part is downward trend. Wave 3, you can call this as an upward trend only if this wave is bigger than this or this. When I say bigger, you see the size, big, that's all. Then wave 2 is less than wave 1 and wave 4 is less than wave 3. So, if this follows this pattern, then this is particularly called as an upward trend. Same way, ulta happens in case of a downward trend. Okay, so this is what this Elliott wave theory is all about. Next, something that is very, very important, which I think they will ask or they should ask at some point of time, explain the random walk theory. What is the random walk theory? According to this theory, prices of shares can never be predicted. It is random. They move left, right, center, random walk. The reason is price trends are not result of any underlying factors, but they represent a statistical expression of the past data. And there may be periodical ups or downs in share prices, but no connection can be established between two successive peaks and troughs. That is, high peaks means high price of stocks, troughs means low price of stocks. So this theory basically says the prices cannot be predicted; they moved at random, and history tries to determine future. And there is some statistical tools that are involved, and there are maybe periodic ups and downs, but no connection can be established between two subsequent movements, two successive peaks. Then we look at what are various charting techniques. I will explain this in detail. You have line charts, bar charts, candlestick charts, point and figure charts. Okay, these are various kind of charts. While this may not be an important question, but I think that this is something that is there as part of this particular chapter. So what are the various charting techniques? You have this line chart, simple line chart. You basically plot which way the price is moving along with the volume. That's all. Then there is something called as bar chart. A bar chart basically has bars. These are the bars. Okay. So if you look at this, the left hand side indicates opening price, right hand side indicates closing price. The top is highest, this is bottom. Same way, opening price is higher whereas closing price is lower because it's on the right hand side. You basically draw a bar chart which basically shows which way direction. It not only shows the overall trend, but it also shows every day what is the high, low, what is the opening price and closing price. Okay. Then you have something as candlestick chart, Japanese candlesticks. What are these candlesticks? Basically an empty candlestick versus a filled candlestick. An empty candlestick basically says that the closing price is higher than the opening price, whereas a closed candlestick says opening price is higher than the closing price. So if you have lot of blacks or lot of filled candlesticks, it basically means that opening is consistently higher than closing, meaning it is closing lower than opening, meaning the price is going down every day. Whereas if you have a consistently lot of empty candlesticks, it basically means that every day it is opening it higher than previous day's close. Okay. Then you also have something as a doji candlestick. A doji is a candlestick pattern that looks like across as the opening price and the closing price are equal or almost same. When looked at in isolation, a doji indicates neither buyers nor sellers are gaining. So if it is consistently black, it means that bears are winning. If it is consistently empty, it means that bulls are winning. If it is consistently like this, where open and close are almost at the same price, then it means that the market lacks direction. Okay. This is called as a doji candlestick. This is called as a doji candlestick. Then what you have point and figure chart. So basically in a point and figure chart, what you do is they are more complex than these line or bar charts. They are used to detect reversals in a trend. These charts do not consider passage of time. For plotting a point and figure chart, we must first decide the box size and the reversal direction. So what you do is for every 1% up move, you plot an X, and for every 3% down move, you plot an O. So you keep plotting X and O like this, and then you see which way it is going. Basically, it gives you some kind of a trend. Okay, these are the three kinds of charts that are available. Let us move to the next question. What are various market indicators? So what are the market indicators? There is something called as market breadth. There is something called as volume of transaction. There is something called as confidence index, and then there is something which is called relative strength index. There is something called as odd lot theory. Okay, these are the 5 kinds of market indicators. So I will explain to you each one of them. Market breadth basically measures strength of the market, number of stocks that are going up versus number that are coming down. Okay, if more people are going up, then the market is in a positive bullish trend. Volume. So if index is rising, volumes are increasing, then it is bull phase. If it is falling and volumes are increasing, it is bear phase. If it is the stock or index is rising, but the volumes are decreasing, then it means that it is a reversal of bull phase. And if the index is falling, but the volumes are decreasing, it means reversal of bear phase. Okay, that is how you look at volumes. Then you have something called as confidence index. What is this confidence index? It measures investor confidence by comparing respective average yields of high grade bonds and low grade bonds. The yield on high grade bonds is lower than riskier bonds. So the confidence index will never be more than 1. So yield on high grade bonds. What is the yield on a high grade bond? Let's say is 5%. Low grade bond, let us say it is 10%. So this ratio, this 10 and 10 will never be same, or the high grade bond will, what do you mean by high grade bond? Bond that has better credit rating. So will Reliance and some local company have same credit rating? Will they both raise money at the same level, same rate? No. So Reliance will always raise at a lower rate, and some unknown private limited company like anyone that you know of will raise at a higher rate. So this ratio will always be less than 1. Now, what is the point of this confidence index? A rising confidence index means that high confidence level, low risk and lead indicator to rise in market. So, as the index keeps increasing this value, right. So, 5 by 10 is what? 1 by 2, which is 0.5. What is 5 by 12? 5 by 12 reduces, or let us say 5 by 15 is 0.33. So, it is reducing. Whereas, what is 5 by 8? 5 by 8, 5 by 8 is some number, I think it is some 6.125 or something, whatever. From 5 to 6.125 it has moved up, it means basically that 0.6125, sorry, 0.6125. Okay, it basically means that there is an increase in confidence and in future the market will rise. What is fall in confidence? When low confidence levels, high risk, lead indicator of a falling in market, exactly the opposite. Then you have something called as relative strength. So, basically, this measures the speed and change of price movements. RSI oscillates between 0 and 100. Traditionally, an RSI is considered overbought when it is above 70 and oversold when it is below 30. Investors will earn higher returns by investing. So, this basically you try and arrive at a relative strength. How is this done is not part of our syllabus, but I have explained this in the my full-fledged classes. Then there is something called odd lot theory. This is a contrary opinion theory. It seems that the average person is usually wrong and hence in course of action is to pursue strategies contrary to popular opinion. So, you always do ulta. You are a contrarian. So, that is called as odd lot theory. These are basically the market indicators. You have something called as resistance, below which the price does not go very easily. Support, below which the price does not fall very easily. Then you have something called as moving averages. Moving averages are frequently plotted along with prices to make buy or sell decisions. There are two types of moving averages, arithmetic and exponential. So, arithmetic moving average is simple, last 7 days average, last 10 days average, last 20 days average. So, people typically look at 200-day DMA and 50-day DMA and 100-day DMA. So, they make comparisons like one moving average is coming above the other moving average, then it means that it is upside, it is downside, so on and so forth. So, what are these trends? Bullish trends. Stock price line rises through the moving average line when the graph of the moving average is flattening out. So, this is bullish trend. When moving average is flattening, stock price is rising above it. This is a bullish trend. Stock price line falls below the moving average in which it is rising. So, moving average is going up, but the stock price is slightly come down. Then, stock price line which is above the moving average line falls but begins to rise again before reaching the moving average line. So, this is the moving average line and this is the stock line. So, the stock line cuts it once or twice. These are all bullish sentiments. What are bearish sentiments? Exactly ulta. Stock price line falls through the moving average line. So, this is the moving average, stock price goes up and then crash. Then, stock price line rises above the moving average which is falling. The moving average is coming down, so temporarily it has gone up, that is all. Then, stock price line which is slow moving average line, stock price line which is slow, moving average line rises but begins to fall again before reaching the moving average line. So, basically moving averages come down, the stock price briefly went up and then is again fallen below the moving average. These are all bearish trend indicators. These are the bearish trend indicators. So, you have to understand first of all what are moving averages and then you have to come out. Now, one very important aspect that we have to discuss here is about this exponential moving average. I think in 1 year or one attempt they asked somebody to compute EMA, or I don't think they asked, but the question is there in study material. Yes, I am right. So, question is there in study material, but I don't think this question was ever asked, or let me just check. It was asked. This was asked. So, we have three types of questions: EMA, run test and autocorrelation. I missed out this EMA. This question was asked actually in the exam. So, we have to know that also. What is it that we have to know? So, exponential moving average, basically instead of computing arithmetic average, which is last 10 days average, last 12 days average, last 50 days average, last 100 days average, what you do is exponential moving average assigns decreasing weights with the highest weight being assigned to the latest price. So, you compute an exponent called A. A is 2 by n plus 1. Let us say you are doing a 30-day moving average or 20-day moving average, or you arrive at a value of n. Then you compute a value of A which is 2 by 30 plus 1, which is 2 by 31. It comes to some number, okay. That number you use and every day you compute something called as EMA, which is this A into today's price P1, which is today, plus 1 minus A, because when you do 2 by 31, you will obviously get a very small value, but 1 minus A will be a very large value, that into EMA of previous day. So, previous day EMA has higher weightage, current day price has lower weightage. Weightage is in the proportion of the exponent is used for current day and 1 minus exponent is used for previous day EMA. Like that you compute a moving average. Once you compute the entire moving average, if the stock price is higher or lower than the EMA, then you make decisions like what we discussed earlier, buy and sell decisions. Okay, there is a question, we will see that particular question as we move forward. Okay, or otherwise, why don't we see that question right away? Why don't we see that question right away? Okay, so let us look at this question. Closing values of BSE Sensex from 6th to 17th in the month of January of 2020 are as follows. So they gave for 12 days, 6, 7, 8, 9, 10, 11, 12. So in between they may not, some days may be there, may not be there, or even if some days are not there, it is not a problem. See, no trading on Saturday, Sunday, no trading. Like that they have given data. Calculate the EMA of new Nifty during the above period. The previous day EMA of Sensex can be assumed as 15,000. At one place they said Sensex and then they said Nifty. What is this? It has to be Sensex only at both the places. Okay. The previous day EMA of Sensex can be assumed as 15,000. The value of exponent for 31 days is 0.062. So what did I tell you is exponent? Exponent formula is 2 by n plus 1, that is 2 by 31 plus 1, which is 32. 2 by 32 is 1 by 16. 1 by 16 is 0.0625. And what did they give? They gave it as 0.062. Okay. So how do you do this? For first day, you take the Sensex value. That is the value for that is the day 0 value. Previous day EMA, they said for the first time when you compute, assume it as 15,000. So what you do is exponent is 0.062. You multiply 0.062, which is current days with current day's price, and you multiply 15,000 into 1 minus 0.062, you get a value called 14,970. Same way you keep doing for every day. So let's take this day. Previous day EMA is 15,130. So that 15,130 comes here. With 17,000 you multiply 0.062. With 15,130 you multiply 1 minus 0.062. Like that you get a value called 15,246. So what basically is happening is this current day's price has having a small impact. Now like this, when you compute, you basically have computed the EMA. Now they have not asked in the question, but what is the direction or where is it going? So if you see on the last day, the index is at 18,000, whereas EMA for the day is only at 15,000. So the price is much higher than EMA, so it is basically a bull phase. Okay, it looks very obvious when you look at 14,000, 15,000, 16,000, 17,000, 50, 18,000. Obviously, we know that price is going up. But when you compute it using EMA, you have a technical basis for that. That's all. Okay, so this is the question that you can ask. It was asked, I think, once in the exam. It is there in the study material. Okay, let us move back to the next question. So, what are these price patterns, or what are basically these trends that we are talking about, which can be analyzed in technical analysis? Though there is no specific question that has been asked or that is there in the material, I think it pays to understand what are these price patterns. So you have something called as a channel. Channel means basically it's a movement with both sides being very clearly defined, both edges being defined. So if you have upward, this is an upward channel and this is a downward channel. So you have an upward channel and you have a downward channel. Upward channel, ascending channel is a uptrend, descending channel is a downtrend. Then you have something called as a wedge. Wedge means you have two broad things coming down to a narrow end. So this is a wedge. So when you have wedge, falling wedge with decreasing volume. So price is falling. So what happens in a wedge? The price is falling, but the consecutive high is also lower. So it keeps going up, down, then the next high is lower than the previous high, like this. So a falling wedge with low volumes is a bullish indicator, whereas a rising wedge with low volumes is a bearish indicator. How does this work? It basically is human psychology, or in fact it is behavioral economics. So if there are low volumes, it basically means there is not much support to this particular move. So if there is no support, there will be a breakout. Breakout means it moves against this direction, right? Then you have something called as head and shoulder. So this is called as a head and shoulder pattern. Right, if you have a head and shoulder pattern, then it is a bearish trend. Then if you have an inverse head and shoulder, which is ulta head and shoulder, it is a bullish pattern. Then you have something called as a triangle. So wedges are where there is both the lines don't touch, whereas in a triangle both the lines touch. So a symmetric triangle, ascending triangle and descending triangle. So a ascending triangle is bullish trend, this is bull, and a descending triangle is bearish trend. And then a symmetric triangle is not clear. So bullish trend, why is it bullish trend? The price is going up, but every successive low is higher than the previous low. So what it means is there are not enough people willing to sell. So it means that basically the price is going to go up, and exactly opposite happens for bearish trend. Then you have something called as coil. You have something called as flag. The coils happen when market has been artificially held down. Analysts look for triangle patterns on charts to spot potential coils. In this chart pattern, as the upper and lower parts of the triangle move closer towards one another, more price pressure builds up. At some point, prices will move outside of the triangle's boundaries. Then you have something called as a flag. You have a downward flag and you have an upward flag. A downward flag is temporary bearish trend and an upward flag is temporary bullish trend. Then you have a pendant. Pendant means you have a single line. For that you have a triangle attached, and when you have a pendant, when there is a large movement in a security known as flagpole followed by consolidation period, it is followed by a breakout in the same direction as the initial direction. So there is an initial up move, then there is a small consolidation, again there is an up move. So this is called as a pendant. Then you have double top and double bottom. So initially we saw head and shoulders. Now we are seeing something called double top. So double top. Double top indicates basically a bearish trend, and a double bottom. What is a double bottom? Double bottom is like this. This indicates a bullish trend. Then you have gap up and gap down. So basically next day it opens at a very, very different rate compared to previous day's close. That is called gap up opening. Same way, next day it opens at a very, very different rate compared to the previous day. On downward side, it is called gap down opening. These gap ups and gaps down indicate bullish or bearish trends. Okay, so these are kind of technical analysis, kinds of indicators, tools that are used in technical analysis. Okay, then we have something called as efficient market hypothesis. This is an important one. What is efficient market hypothesis? An efficient market hypothesis is one in which the market price of security are unbiased estimate of its intrinsic value. So all possible information is available in the market. This means that the market efficiency does not imply that price equals intrinsic value, but price can deviate from intrinsic value, but the deviations are random and uncorrelated. So basically there is a price and there is an intrinsic value. The deviations from intrinsic value are very random. You cannot find out how or why it is so different. Randomness of stock price is a result of efficient market that is caused due to following reasons. Just because they are random doesn't mean that the market is inefficient. Actually, it means ulta. It means that the market is efficient and hence the prices are random. Information is freely and instantaneously available to all participants. Keen competition amongst market participants ensures that market will reflect intrinsic values, and price change only responds to new information that is unrelated to the previous information and hence therefore unpredictable. So what basically is, a lot of information is there. As new information keeps coming in, that new information is random. So the new price is also random. There is a lot of competition in market participants. So hence each one comes out with new analysis, new research, new information, which is random. Right, and price changes is response to the new information. So these are the underlying reasons why in an efficient market the price movement is very, very random. Then what are the misconceptions of efficient market hypothesis? This is a good point what we discussed. Market has perfect forecasting abilities. No, because it is efficient does not mean you can forecast. The hypothesis merely implies that prices reflect all available information at that point of time. Does not mean that market has it does not mean that one can perfectly predict the future. As prices tend to fluctuate, it does not reflect fair value. Unless prices fluctuate, they would not reflect fair value. Future is uncertain and market is based on continuously changing new information. So prices have to consistently change because new information is coming out at every point of time. Lack of competence of FIS, DIS and portfolio managers. Market efficiency exists because these people are doing their job and hence new information is coming out based on which the market is reacting. Stock market is irrational due to random movements. No, if the investors are rational and competitive, price changes are bound to be random. If all of us take our own decisions based on some logic, then we will have a price, somebody else will have some other price. Okay. What are the challenges to this efficient market hypothesis? Following are the challenges. Information is neither freely available nor rapidly transmitted to all participants. Human information processing capabilities are limited. It is generally believed that investors' rationality will ensure a close correspondence between market price and intrinsic value, but that is not true. And powerful institutions and operators can always influence the price. The efficient market hypothesis, like all theories, is imperfect and limited description of the stock market. Most academic researchers consider efficient market hypothesis a seminal breakthrough supported by considerable empirical evidence. So what they are basically saying is, it is a theory, it is not 100% perfect. There are misconceptions and there are reasons why those misconceptions are incorrect, but there are some challenges. That is, such a perfect market does not exist. All human beings are not necessarily rational. The market may be monopolistic in nature. Some big people may influence the prices. And we cannot process all available information that is for us to take a price decision. Okay. So, these are the challenges to efficient market hypothesis. Then, what are differences between fundamental and technical? Very, very clear. Fundamental depends on, it is measured by economic, industry and company analysis. But technical analysis is based on historical data, price movements, volume, open interest. Rules: prices of a share discounts everything, prices captures everything. So, that is a fundamental distinction. In a fundamental analysis, you discount all future cash flows. In a technical analysis, the price captures all available information as on today. Usefulness: if the fundamental analysis is more long term and technical is more short term. What are various forms of efficient market hypothesis? This is also a very important question. Eugene Farmer suggested 3 forms of efficiency: weak, semi-strong and strong. In a weak form of efficiency, prices reflect all information in record of past prices, volumes, rate of return, etc. This means there is no relationship between past and future prices. So, basically this reflects all past information. In a semi-strong form of market, it is slightly better. Only public information is reflected, information is reflected in the price. In a strong form, public as well as private information, both are reflected in the price. So, these are the 3 forms of market efficiency. Next, last question, 19th question: what are various tests to determine levels of efficiency of the markets? You have serial correlation test, which is the auto correlation test that I was telling you about. You have a run test, which is what we are going to solve about, and you have something called as a filter rule test. These, if a particular security's prices follow, or they are able to satisfy any of these 3 particular tests, the market is at least weak. Please note the words at least weak, which is why when we run the autocorrelation test and this run test, we say that the market is at least weak. It may be semi-strong, it may be strong also, but it is at least weak. I will explain to you these tests in slightly greater depth as we move forward. Semi-strong market, they have done event studies, portfolio studies and time series analysis to figure out what, whether a market is semi-strong. In case of a strong market efficiency, it is evaluated by analyzing returns of corporate insiders, stock specialists and security analysts. Let me take you through slightly in depth of each of these aspects. First one is serial correlation test. What are we doing in a serial correlation test? You are basically trying to say previous day price and current day price are not linked at all. This is exactly ulta of our moving average EMA, right? There we are saying that there is some linkage. Here we are saying that there is no linkage. So, if the price change in one period correlated to price change in some other period, if such autocorrelations are negligible, that is they are very small, the price changes are serially independent, the market exhibits at least weak form of efficiency. Studies employing different stock, different time lags, different periods have been conducted to detect serial correlation, but no significant correlation has been discovered. If correlation is low, at least weak form of market efficiency exists. If correlation is high, it is an inefficient market. How do you find out correlation? First you find out the covariance. And using covariance you find out the correlation. Correlation is R is equal to covariance by standard deviation of both the securities, right. So, you find out correlation between 2 independent sets of data points and figure out what is the correlation value. The correlation is low, then the market is at least weakly efficient. Can we look at a problem here? Right now we can solve off one problem. This is a question. Closing value of TCS for the month of Jan and August 21 are as follows. So, you have a set of values from 30th August till 30th August, 2nd August to 30th August, then 1st Jan to 29th Jan. So, you have a set of days. How many days? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. Okay. What you have to do is, when you come to the solution, first you plot the data from bottom to top. That is 30th comes on the top because it is dependent on the previous day's price. Okay. So, you first take all the closing prices, change from the previous day. You always figure out what is the change in absolute terms. Now, here in this particular question, they took actually the absolute change. When you do autocorrelation test, you actually do it on percentage basis. You don't do it on absolute change. So, see here 3720. Let me clear this. 3720 and 3701. From 20 to 1 it has fallen. So, basically some 19 points. You don't take it as 19 points, you take it as 19 upon 3720, whatever percentage that comes, that probably comes to I think some 0.5% or something, right. So, you should actually do the serial correlation test for percentage points. If they ask you in the exam, do it. If they have said do it based on prices, do it based on prices. But logically in real world, whatever I have seen, it is always done on percentage return. Okay. So, you find out all the changes. Okay, then you compute an average of change which comes to 25.45. You take average of all these changes, it comes to this much. So you have something called as x, you have something called as x bar. X bar is basically the mean. Subtract from each value the mean. So 18.75 minus 25.45, which is 40 minus 44. Like that you do x minus x mean for all of them. Then you do x minus x mean whole square. What does this resemble? This resembles your standard deviation formula. That is what we are going to find out. There are 19 data points. You found out the average or mean as this. You found out the x minus x bar whole square. You did sigma x minus x bar. You are doing all this for August, please note. Sigma x minus x bar. Then you do sigma x minus x bar by n. Then which is what you get as variance. Then you do square root of variance, you get the standard deviation. So here in this case, these are all very lengthy, painful, dirty problems. Honestly, that is my opinion. Okay, because you should do this on Excel. There is no point doing this on pen and paper because you will tend to make mistakes. Anyway, Institute in its infinite wisdom has chosen to ask, so I am nobody to comment on it. Okay, so you have x minus x bar whole square, and then you compute the square, you get a standard deviation value. What will you do with the standard deviation value? Wait. You complete this part, then do the same exercise for January also. Do this for January. For January also, you plot all the prices, look from the changes from the previous day, find out the mean. You got the mean as 9.72, subtract from the mean x minus x bar, then do x minus x bar whole square, then you will get a bunch of values. When you get bunch of values, you get variance and then you get the standard deviation. So you got the standard deviation as 52.83 and here you got the standard deviation as 35.24. What are you supposed to do? You are supposed to find out correlation. What is correlation? Correlation is covariance divided by standard deviation of both the individual securities price changes. So, how do you find out covariance? Covariance formula is sigma x minus x bar into y minus y bar whole by n. So, you do x minus x bar, which you found out here, or you call this as y, you call this as x. So, you multiply 44 with 96. So, you will get 4,200. Like that you do for all of them. This is a very painful thing. Okay. So, you do all of this, you add it and then you will get a number which is basically x minus x bar into y minus y bar. That you divide it by n, which is n 19. So, when you do that by n, you basically get a covariance. Covariance is how much? 5819.018 divided by 19. You get covariance of 306.26. Okay. Which is what I wrote here. Then you find out correlation. What is correlation? Correlation is covariance by standard deviation x, standard deviation y. So, that is 306 divided by 35 into 52 or 53, whatever it is. You get a correlation of 16%. Now, what is a good correlation? That they should ideally give in the question. If they have not given in the question, if they have not given this in the question, typically anything that is less than around 35-40 is basically, or even 50, sometimes in exceptional cases, at least 35-40, if it is less than 35-40, then it is low correlation. If there is low correlation, it basically means the prices of the past and the prices of the future are not linked. Here, August and Jan, no, so it basically is some 211 days. So, the past and future are not linked and hence there is no correlation and hence it is at least weakly efficient form of market. Okay, at least weakly efficient form of market, right. What was the specific question? You test the weak form of market efficiency using autocorrelation. That's all. Okay, this is a very dirty problem, honestly. That is why you should do this on Excel or something rather than doing it in pen and paper. Now, let us look at that other question, serial correlation, autocorrelation. What did they say? Mr. X's opinion that market has recently shown weak form of efficiency. In order to test the validity of his assumption, he has offered the following data relating to movement of Sensex for the last 20 days. Please note here, they have given 20 days data, open, high, low, close. You are required to test the weak form of efficiency using autocorrelation test taking a time lag of 10 days. I think this was the question that was asked in the exam, if I am not wrong. So, you have Sensex 20 days. Now, what are we supposed to compute? Autocorrelation lag of 10 days, what does it mean? It basically means today's price is linked to price 10 days ago, yes or no. If it is linked, if they are correlated, it basically means that it is not weak form, it is an inefficient market. If they are not correlated and they are independent, then at least weakly efficient market. How will you trace the correlation? What is the value of correlation? So, you have to find out the correlation between two data points. Data point from 11 to 20 and 1 to 10 and put both of them side by side. So, in this question what you do is, first you have been given data, day 1 to 20, you first write it down in descending order. Descending order means first day 20 and then 20 to 10 and then 10 to 1. Once you sort this, typically you do this for closing values. Okay, that is 1. Then once you put them both side by side, 20 to 11 here, 20 to 11 here, and then 10 to 1 here. Then you count the number of changes. So because you are putting 10 points, you will have 9 price changes. For all those price changes, find out the average. Then subtract each price change minus average. When you subtract each price change minus average, you get these values. 2.5, 18.82, so on and so forth for first data, and 26 and so on and so forth for the second set of data. Once you do this, x minus x bar whole square, y minus y bar whole square, and you have to also do x minus x bar into y minus y bar. Why do you need to do? Because you need to find out the covariance. So what you do is, covariance is x minus x bar into y minus y bar by n. You get a value of 182. Then you do also find out the standard deviation. How do you find out the standard deviation? Sigma x minus x bar whole square by n, which basically gives you the variance. So you find out for each of them what is the variance. Then you find out the standard deviation. Then you compute what is the correlation. Correlation will be covariance by both the standard deviation. So here correlation is coming to 40%. As I said, 40% also is just border case. So you can say that it is weak form of correlation, or no correlation exists. So and hence it is a weak form, at least weak form of efficiency market is what you can say. Typically, 40 is border case. Above 50 is definitely good correlation. But 40ish also you can say that is not necessarily, above 40 also sometimes people say it is good correlation, but I think 40 is fair enough because we are lying at the border. Okay, so this is how you solve this particular question. You can actually look at my video where I have solved this. Anyway, we have completed one aspect. Let us go to the next one. Then you do something called as a run test. This is the second kind of test that we do. What do we do in this? You find out the number of runs. So let's say the stock is going up. This is one run. Stock is going down. This is one run. Okay, here the direction has changed, so the run has changed. So you have positive runs and negative runs. So each momentum, basically you are trying to figure out the momentum. If it is going up 5 days, then that entire thing is called one run. If it is going down 3 days, the entire thing is called one run. So let you compute the number of runs, and then you say whether these runs are independent or not. So what you basically do is, run occurs when there is no difference between sign of two changes. When the sign of change differs, the run ends and a new run begins. That is what I was explaining you. In a market with weak form of market efficiency, runs are independent. The runs are not linked or related. If the number of runs R lies between mu is mean plus or minus the t value. Okay, plus or minus t value. If it lies within this range, then the market exhibits weak form of market efficiency. If it is outside this range, then it is an inefficient market. Now, basically if it is outside means the runs are not independent, runs are dependent. Okay, so how do you compute this mean and what is this whole t value? We will look at. So what is mean? Mu is equal to 2 n1 n2 by n1 plus n2 plus 1. So n1 is basically number of positive runs, n2 is the number of negative runs. So n1 into n2 by n1 plus n2 plus 1. So this gives you a mean value. Then you find out the standard deviation. Why do you need to find out the standard deviation? Because your whole purpose is to find out two limits within which the number of runs fall. So you find out the mean runs plus some standard deviation, mean runs minus certain standard deviation, and whether the number of runs actually fall within that or not is what you are supposed to test. So you have to find out the standard deviation. What is standard deviation formula? 2 n1 n2 into 2 n1 n2 minus n1 minus n2 by n1 plus n2 into, so what is variance? Variance is 2 n1 n2 into 2 n1 n2 minus n1 minus n2 by n1 plus n2 whole square into n1 plus n2 minus 1. This is variance. So standard deviation is square root of variance. In a T distribution, you have something called as degrees of freedom. So the number of runs minus 1 determines the degrees of freedom. Okay, how will this degrees of freedom help you? Let us look at a question, only then you will understand this process. We have I think 2 or 3 questions, we will solve those and then we will be done with the questions also at the same time. This is the closing value of stock market index for the month of October. So let us look at this question. The closing value of stock market for the month of October is given below. So you have bunch of dates. You are required to test the weak form of efficiency by applying a run test at 5% and 10% levels of significance. The value of T at 5% is 2.101 at 18 degrees of freedom. Value of T at 10% is 1.734 at 18 degrees of freedom. What is this degree of freedom? What is this T value? I will explain. First they have given values here. How many? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. I think they have given 19 values. 17, 18, 19. Yes, they have given 19 values. When they have given 19, yeah, see number of sign changes is, no, they have given 20 values. They have actually given 20, my bad. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 13, 14, 15, 16, 17, 18, 19, 20. So, they have given you 20 values. For 20 values, you can only have 19 runs because for the first day, we don't know what is the run. So, you basically plot from in ascending order from decrease from 1st October till 31st October. Then you plot the number of runs. So, every time sign changes, the run changes. So, first time it is 2800 to 2780. So, it is minus. So, that is first run. Why? Because the second run is increase, which is different sign. So, it is plus. So, it is a different run. Third day, it is again an increase. So, it is plus. So, the previous two together form a run. Like that, you compute the number of runs. So, how many runs are there? Totally 8 runs, but there are 19 sign changes. 19 sign changes. So, number of plus is 11, number of minus is 8 and runs are 8. Okay. So, what you do is, you go to the T table. What is the T table? I will take you through what is the T table. So, you will be given a table, one-tailed or two-tailed. So, if you come to this table, 18 degrees of freedom, you look at where these data points are, 2.101 and 1.734. So, you see here, this is for 5% and this is for 2.5%. So, here they have given 1.734 and 2.1, but here the values correspond to 0.025 and 0.5, because if it is 0.025, which is basically 2.5% on one side, it basically means on either side it is 0.25, 0.2, 2.5 and 2.5. So, basically it means 5%. Both the sides put together is 5%. So, one side is 2.5%. So, they have given the value for one side 2.5%, which is 2.1, and one side 5% means, basically one side 5% means both sides 10%, which is 1.734. See, which is why the 10% value is lower than 5% value. Okay. Now, once you do this, what do? You compute the mean. Okay. What is the mean? 2n1 n2 by n1 plus n2 plus 1. So, you get a mean of 10.2%. Then you compute the standard deviation, the big formula what we have, 2n1 n2, 2n1 plus n, 2n1 n2 minus n1 minus n2 by n1 plus n2 whole square into n1 plus n2 minus 1, all that. And then once you do a square root, you get a standard deviation. Once you got the standard deviation value, what are you supposed to do? You are supposed to compute mu plus sigma and mu minus sigma. You have to do this for 5% separately, you have to do this for 10% separately. Sigma into t value, it is not just sigma, okay. So, for t value will be different. T value for 5% is what? T value for 5% we have just found out, no, what is it? 2.101. So, what you do is, mean is 10.26 plus, for 5% it is 2.101 into standard deviation is 2.06. This is plus, this is 10.26, 10.26 plus 2.101 into 2.06, this is 2.06, and 10.26 minus 2.101 into 2.06. So, you do this for this number 2.101 will change to 1.73 when it is a 10% test. So, like that you do and you find out the values. This value comes to 14 and minus comes to 5. So, the number of runs 8 is between 5 and 14 and hence this lies within the t values and hence the values are independent and hence it exhibits weak form of efficiency. Same way, when you do it is at 10%, it is between 6.6 and 13, 8 is lying between 6.6 and 13, hence it is independent and hence it is at least exhibits weak form of efficiency. So, this is how you solve a problem. I know this sounds slightly complicated, but you solve one problem, you will understand it very well. Okay, let us look at one more problem on this. The closing value of TCS stock for a month is given below. For the month of August, you have been given bunch of prices. Those prices again you plot in increasing order starting from 2nd August to 30th August. You have totally 20 data points for 19 sign changes and you have again 8 runs. You have 15 positive, 4 negative, total runs is 8. What you do is, in this you don't try and find out the differences and all that. All you are trying to look at is whether it is positive or negative. This is actually a very easy problem if you get in the exam. All you need to do is remember this stupid formula. Okay, this formula is only confusing. So, what is the mean? And again they have given this 5%, 10% significance values. Mean is 2n1 n2 by n1 plus n2 minus plus 1. So, you get mean as 7.32 and standard deviation is under root of 2n1 n2 into n1 plus n2 into 2n1 n2 minus n2 divided by n1 plus n2 whole square into n1 plus n2 minus 1. If you do that, you get a value of 1.37 as standard deviation. So, mean plus or minus t value into standard deviation. That is the rule. So, t value is given as how much? 2.1 for 5% and 1.734 for 10%. So, you basically compute the values, you got 10 and 4 and 9 and 4. In both the cases, the number of runs 8 is lying within them, within these boundaries. So, these depict the boundaries. This is the boundary, the runs is here. Okay. So, this is very close with lying well within the limit of the boundaries of this particular for this particular distribution, it lies within these boundaries. So, hence it is, these are independent and hence the market at least exhibits a weak form of efficiency. Okay, very simple problem. You can actually look at it in the compiler that I have given. We have finished these two, serial correlation and run test. Now let us go to the filter rule test. What is filter rule test? An n% filter rule may be defined as follows. If the stock price increases by n%, buy and hold until its price decreases by at least n% from a subsequent high. When the price decreases are at least n% or more, sell. So basically you define every 5% I will take an action. If the stock moves up by 5%, I will buy. If the stock falls down by 5%, I will sell. Like that you do, and if the behavior of stock price is random, the filter rule should not be able to outperform a buy and hold strategy. So, if you do this kind of strategy and you compare this with a buy and hold, this kind of a strategy should not outperform a buy and hold strategy. If it outperforms, then it is an inefficient market because there is momentum. Whenever it is moving up, it is moving up. Whenever it is going down, it is going down. And those kind of price changes have to be necessarily random. So, studies suggest that filter rule do not outperform a single buy and hold strategy, particularly after considering commission or transaction. So, they can never outperform a buy and hold. If they outperform, then it is an inefficient market. If they do not outperform, then it is a market is at least weakly efficient. Then semi-strong market. What is a semi-strong market? In these kinds of market, prices reflect not only all information found in record of past prices, but all other publicly available information. By using this information, investors will not be able, by using publicly available, because it is prices already reflect public information, using that you will not be able to make any extraordinary gains. So, how have they tried to check for this? They have done event studies. What is an event study? An event study examines market reactions to the excess market returns around a specific information like acquisition or stock split. You identify the event, collect the returns around the announcement date, calculate the abnormal returns around the date, compute the average and standard error of the abnormal returns across all firms and assess whether the excess returns around the date are different from zero. So, you try and see when you have dividend, stock split, bonus and things like that, try and see the returns around that date. If those returns are random, then the market is semi-strong. If those returns are not random, if somebody is able to, those returns are positive or negative, right, then that particular market is, it's not a semi-strong market. If they are random, it is a semi-strong market. What are the results of event study? Stock splits. Prior to the stock split, the stocks earned higher returns than predicted by the market. After the split, stock earned returns which were more or less in conformity with the market. So, whatever market expected, got it. Announcement of accounting changes. An accounting change that has no economic significance has no bearing on the stock price. An accounting change that has economic significance is reflected rapidly and rationally in the stock price. Corporate events, the market reacts rationally and rapidly. It reacts rapidly. So, nobody can make an extraordinary gain. Unexpected world events and economic views. Markets react rationally and rapidly to this kind of news. Attack on World Trade Center about GDP growth, money supply, all of these cases, they will react very, very rapidly. Even with all such rapid news, sometimes they will be downwards, sometimes will be upwards. On a cumulative basis, it is random and there is no positive gain that anybody will make. Then portfolio study. Portfolio studies attempt to determine whether public information can be used to predict what stocks will earn superior. Define the characteristic which firms will be classified. Classify firms into portfolios based on magnitude of the variable. Compute return of each portfolio. Calculate the abnormal return in each portfolio. Assess whether the abnormal returns are different across portfolios. So, what you do is, you take low PE stocks outperform high PE stocks even after adjustment for risk. So, this is what they figured out. PE ratio, low PE stocks always outperform high PE stocks. Okay. PEG, an inverse relationship exists between PEG and subsequent rates of return. Empirical evidence relating to this seems to be mixed. So, there is no clarity. Size effect, stocks of small firms on average outperform the stocks of large firms on a risk adjusted basis. These are the things that they found out. Based on these, what did they do? They attempted to determine whether information can be used to predict. Now, these rules they have figured out, or rather these kind of results they figured out some kinds of portfolio. Across portfolios, they found no major difference. So, if you are not finding any major difference, it is a semi-strong market. Then you have time series. Time series starts with an assumption that in an efficient market, long-term historical rates of return represent the best estimate of future rate of return. This analysis determines whether any public information will provide superior estimates of returns over different periods of time. So, dividend yield and stock market returns. A positive relationship exists between dividend yield and future returns. Quarterly report. Stock price adjusts gradually and not rapidly. winner and loser portfolios. It was found that extreme losers become too cheap and earn returns, and extreme winners become too expensive and earn lower returns. Calendar anomalies. Investors sell stocks on which they have lost money in December to get tax benefit, and stock returns tend to be negative over a period from Friday's close to Monday's opening. Based on this, no clear conclusion can be drawn about semi-strong market opinion. All results are mixed bag. So, based on these things, no specific thing can be done because everything is chaotic. Some are here, some are there, some are here. So, no specific conclusion can be drawn. Now, what is a strong market? In a strong market, not only public but even private information is reflected in stock price. So, corporate insiders, people like MD, CEO, chairman, board, they have information. If they are making more returns than the market, they have other information, right? So, corporate insiders consistently enjoy higher superior risk-adjusted returns. Same way, stock exchange specialists, people who are specialists in the market, security analysts, they have training and advantage, all the research analysts and other people. In a market exhibiting strong form of efficiency, nobody will be able to earn superior returns as prices adjust all information. Studies have shown that such kind of hyper-efficient markets do not exist. Our strong form of efficiency can be found in specific stocks of company sectors that are well regulated and are run in a proficient manner. Okay, so these are the things that you have to understand. So, corporate insiders, stock exchange specialists, and security analysis. So, this cannot exist. This is utopia. Utopia means a land in which everything is perfect. Such kind of perfect markets do not exist in the world. Okay, so these are the aspects that are covered in this particular chapter, and then they have added one more new topic, which is about equity research and tools available. Equity research people are basically people who are, CAs, MBAs, engineers or CFAs and all those. They sit and try and predict stock prices based on the, business model. They understand the industry, understand the sector, understand the company, understand the competitors, and they try and create a financial model. By the way, we also given a financial modeling course as part of our AFM. Right. So, whoever is subscribed to our paid course will also get financial modeling course. There we teach how to create a financial model. Using that model, they predict cash flows, they project future cash flows. Based on that, they project future dividends. Based on that, they predict future price. And based on the price comparing to the current price, they say whether you should buy or sell. They give a beautiful detailed report. In fact, in my paid videos, I've actually also showed you some reports and explained because I myself was a equity research analyst at one point of time. So, what happens in this equity research is people do a lot of research about stocks. They stick themselves to specific sectors or, power, gas, telecom, IT, so on and so forth. And they use tools like Bloomberg, FactSet, then you have Thomson Reuters, Market XLS, Stockopedia. They read a lot of annual reports, industry reports, so on and so forth. These kind of, Y charts, business quant, guru focus, so on and so forth. I'm not sure whether they will ask all of this in the exam, but this is something that I've actually given. This is a new question that can be asked, right? But in real life, all these, they use all tools. They spend a lot of time researching about the sector and understanding the company. They do a lot of reading of annual reports. They talk to company, they talk to the management, they talk to other industry insiders, they talk to industry associations, they attend all con calls, they attend all presentations and so on and so forth, and then they come out with their research report. Okay, so this is about this chapter called security analysis. This is the revision of this particular chapter. The links for my compiler formula sheet as well as the theory, both theory and practical compilers and the formula sheet are available in description. Please go through them and study well.